Most of the people invest in stocks in hoping that their stocks will go up. But what if your portfolio could pay you no matter whether the market is going up, down, or sideways? That is the power of dividend paying stocks. They don't just grow your money, they send checks along the way growing your money. Therefore, if you are ignoring them, you might be walking away from hundreds of thousands of dollars in a passive income. Hi, my name is Mutib Ahmed. I am a chartered financial analyst and qualified accountant with over a decade of experience in investment banking, and I make videos to simplify investments and personal finance. You have to know that dividend is a result of company's dividend policy. Every company has a dividend policy, which begs the question, how dividend policy affect the stock performance? To answer the question of how dividend policy affects the stock performance, you have to look at the research conducted by Net David. The research look at the stocks during the period of 1973 to 2024 and divide the stocks into two categories, dividend payers and non-dividend payers. Number one was the no change. In this category, the companies were selected were the companies which had the constant dividend for the past 12 months. Number two category was dividend eliminators or cutters. These were the companies which basically eliminate or cut out the dividend. And number three was the dividend initiators and growers. These were the companies which basically were growing their dividends. The research indicated that dividend non-payers, dividend eliminators and cutters were basically suffering from negative consequences. According to research results, dividend non-payers, eliminators, they were more volatile as compared to S&P 500 index and they underperform as compared to the S&P 500 index. But when you look at the performance of dividend initiators and growers, you will notice that these companies not just only outperform the S&P 500 index, but they were also less volatile as compared to the S&P 500 index. So that means that dividend initiators and growers basically generated highest risk adjusted return as compared to S&P 500 and as compared to the dividend eliminators, non-payers and rest of the categories. Now that you know that dividend has a positive effect on the stock performance, but the question arises, how much dividend play a role in the total return of the stock? For that, let's look at the total return of S&P 500 for the period of 1940 till 2024. What you will notice that on average about 1/3 of the total return has been contributed by the dividend. But you have to notice that during the period of bear market of 1940s, 1960s and 1970s, when the S&P 500 total return was less than 10%, dividend played major role. But during the bull cycles of 1950s, 80s and 90s, when the total return of the S&P 500 was well into double digits, the contribution of dividend was smaller as compared to the contribution during the bear market. An interesting fact that you can notice that from 1990s onward, there has been a de-emphasis on the dividend, which means companies actually reduce paying dividends as they mostly reinvested their profit into business to grow, to expand, rather than paying out to the investors. And this trend we still see today as the companies prefer to reinvest their profits into business to expand and to grow rather than pay out to the shareholders. Now that you know that roughly 1/3 of the total returns come from the dividend, now this leads to another question, which is whether to buy highest dividend paying stocks. The answer might surprise you, which is no. Highest doesn't always mean the best. For that, we have to look at the research that is conducted by Wellington Management, which basically identified the flaw in this thinking. Wellington Management basically performed analysis on the stocks from the period of 1930 till 2024. They divided the stocks into 5 categories. Number 1 category being the highest dividend paying stocks and number 5th category being the lowest dividend paying stocks. What is interesting to note in the results of this study is that the second category basically outperformed the S&P 500 index from 7 out of 10 times, while the first and the third category outperformed the S&P 500 index for 6 out of 10 times. But this begs the question that how a second category outperform more than the first category when the first category is the highest dividend paying category. One of the reasons which could basically identify why the second category outperformed the first category is the dividend payout ratio. When you look at the dividend payout ratio of the first category, that is 75%, But when you look at the dividend payout ratio of the second category, that is 40%. Now you will notice that's a quite stark difference of 75% and the 40%. Now if a company is maintaining a 75% of dividend payout ratio, that means they are paying 75 cents out of every $1 that they generate in profit as a dividend to the shareholder. And this is good during the period of expansion of economy, but during the period of financial crunch or during the period of recession, this high dividend payout ratio could be seen as excessive and unsustainable. So that means during the recessionary period, company has to cut down high payout ratio to lower payout ratio, and this is seen as the weakness in the fundamentals by the investors, which leads them to sell their stocks as they believe the business is basically weakening and it is better to invest into stable business. And what is the stable business? A stable business is even during the recessionary period, they maintain roughly a consistent dividend payout ratio that we see in the second category, as the second category has been consistently paying a dividend payout ratio of 40%. And that's exactly the reason it basically outperform the first category. You have learned that high payout ratios might not be sustainable by the companies, especially during the recessions, but this begs a question that how much earnings and dividend trim usually during the recession period? If you're asking this question, I'm glad, because here I will share the answer with you. That we have to look at the last 5 recessionary periods between 1973 to global financial crisis during 2008 and 2009. What you will notice that during these last 5 recessionary period, earnings or profits of the companies on average declined by 42%. But it is interesting to note that dividend only decreased by roughly 8% by the companies. That is about 1/5 of the decline in profitability or earnings of the company. That is quite fascinating thing that you have to notice. Another interesting thing that you have to notice that during the global financial crunch of 2008 and 2009, profitability or earnings of the company declined by 92%, but dividend only decreased by just 24%. This means that despite almost 100% of the wipeout of the earnings, dividend only decreased by 24% even during global financial crisis. So what does this mean for the shareholders? For shareholders, this means that the company which basically has cut down their profitability during the recessionary period, also cutting down their dividend, but to a lower percentage as compared to the profitability, is indicative that the company has a solid business plan, they are standing on the solid footings, and they value their shareholders. And these are the things which compels shareholder to buy these dividend paying stocks and give a premium valuation to these stocks.